6 consecutive weeks down. Just when you thought 2025 couldn't get any weirder, it has, with massive corrections across so many markets around the world. But now we face the precipice of a huge decision: recessionary path, or, of course, back to being bullish. In today's video, we take a look at what JP Morgan thinks may happen next based on their momentum indicators. And of course, we need to look at the dark pools and the options flow. As we often say, if it's in the press, it's in the price. So as everybody is absolutely freaking out, should we really be doing so? Join us as we cover stocks, commodities, and cryptos right now together. Well, welcome back everybody to the special weekend edition of The Daily Show. My name's Tom, and in today's video, we have a lot to discuss together. The latest macro, the data, the key levels, and of course, the sentiment reports. It was a pretty bad week for big banks and semiconductors, but some of the defensives we've been discussing all year actually did eke out a profit. So what does all of this mean? Well, let's go to this latest sentiment report and have a look at what retail traders are thinking about these markets. And it probably comes as no surprise to most of you that everybody is still bearish. 57.1% of respondents acted as bearish over the next 6 months, and only 20%, well actually less than 20%, even less bulls were out there this week, according to what's going on. Now, is this justified? Should we really be freaking out like everybody is right now, with markets entering into correction territory on some things like the Russell 2000 and the NASDAQ? Well, as it turns out, probably not, considering the amount of moves, and it's very rare to hit such massive core risk-off models, such as the one here from macro charts, or really anything else in such a short period of time. It really does smell of peak fear, and we really don't see these types of things except for generally through actual sell-offs, such as 2022 near the bottom and 2009 as we were entering into the end of the global financial crisis. It's pretty wild to be down at these levels, but let's just explain what these extreme levels mean for us. It means that everybody is stacking puts. As you'll see later on today's show, basically in the options world, everybody's buying insurance. And you can see that here with the Russell 2000 hitting into critical periods that usually have been synonymous with bottoming style markets. We've got the same thing going on, of course, when it comes to the Qs, that is the NASDAQ, record high put volumes. The same thing happening on the SPY, as we saw last week, with record high put volumes. And then, of course, we find ourselves at 6 consecutive weeks down, which has historically been around the point where the Russell 2000 has actually found buyers. And as you can see here, when we're taking a look at these 6 consecutive weeks, we're getting close to usually what has been a turning point. Now, is it unheard of that this happens during a fairly small sell-off? Well, of course not. It has happened on the Russell 2000 a few times, but the more important thing is the synergy across the board. And it has JP Morgan here claiming that they believe that 90% of the downward move has most likely already happened. Although they did caution, we posted this over on X, that if this long-term shift does continue, and of course we lose these zones right now, that we could be looking at a significant drawdown. Now, if that sounds familiar, you may have watched our previous video where we talked about some absolutely wild stats. The first one I want to mention here was from Subu Trade, which basically just said that we've had over 6 consecutive days of plus and minus 1% changes, while we're actually not in a bear market. We're not 20% below the 1-year high. Now, why is this important? Well, it turns out that when we see this type of vol, it's a little bit different to volatility during an absolute panic fest. It can lead into, and has 100% of the time led into, bullish data stats 2 months later, 3 months later, and even upwards of 1 year later. Now, that's a pretty big stat when you're looking at it. And of course, there are quite a few data reads, but it's the one that I think the most important has to do with, which is the big moving average, the one we've discussed really for the last month and a half here on the channel, which has been the daily 200 moving average. Now, last week we hit it on the S&P 500, we hit it on the NASDAQ, and of course we closed below it on the NASDAQ. Now, this is triggering something we don't see very often. And Jason Gopfert came out and said that in his studies, if the market proceeds to draw down another 3.5% from that close level over the next 2 weeks, that every single time we've been in a significant pullback in the markets after that point. Basically, we would enter into a recession. Have a look at these periods of time and how big the markets pulled back. 43%, 35%, and of course the non-recessionary one, 2022 with a 20% drop, entering just into bear market pull territory, and then of course miraculously recovering. Either way, if we do get this stat, which remember is another 3.5% negative from this level, it will also break price action based levels, including a Wyckoff distribution, which basically is one of the worst signals that we could see on the markets from a technical perspective. Now, why does this make sense? Well, we know the 200 moving average is very important. Last year, we didn't hit it. So in 2024, we didn't actually reach it. And that meant that the market was incredibly strong. And of course, it was quite easy to buy the dip all the way up to the moon. But this year is a little bit more difficult, depending on how the market acts around this point. And remember, if we don't lose 3.5% over the next 2 weeks from the close level under the NASDAQ, the markets were always bullish over the next period. So that's an important one, because as you can see here, the stats around the 200 moving average, it's a coin flip. So of course, structure is going to matter. Now, what numbers are we getting in? Most of you guys were knowing that, of course, the markets were looking at the jobs numbers. But as we know, the jobs numbers were only up to the 15th of Feb. So they will not include some of the Doge firings and some of the other things that we've been seeing on. And of course, some of this tariff stuff that's now being implemented around the world. So what really numbers do we look at? Well, I always like to look at, and I'm sure you guys do too, the revisions. So I posted over on X a couple of the revisions. December was revised up from 307K up to 323K. And January was revised down 143 to 125. Now remember, the problem with non-farms is every number seems to be wrong. So even though we put in 151,000, I think the biggest thing here was the double jobs that people were taking to pay off, I guess, just to be able to live at the moment in these expensive times, and that we didn't see really government layoffs for the Doge firings, tariffs and trade distortions really shown in these numbers, and businesses slowing. Now, remember, businesses were already slowing to hire, which was engineered by the Federal Reserve last year. So that's continuing to come through as well. So many things happening here as we try to unpack this data. Most importantly, though, US labor force participation, you can see it was actually kind of steady here. And what that's showing is that we still may have a possibility that there is some tightness here. We'll have to, of course, have a look at the new jobs numbers. Just remind you guys, this week is now inflation numbers, which is probably the biggest thing that people are worrying about. Why? Because, of course, some people believe, and statistics would show at least, where tariffs are implemented on certain things, they've generally led to higher prices in that area. So now that we're seeing that again in 2025, will we see that coming through? Well, these are the numbers that we'll start to get over the next couple of months. Now, is it normal for March to sell the way it has? February, of course, was weak. Is it normal for March to also see some weakness? Well, historically, yes. And of course, there are a lot of ways to cut this data. Generally, in post-election years, you kind of see a little bit of a pickup at the start of March, the first couple of days. Then you see a sell-off. Then we see a rally near the end. And then we basically go on to do okay. Now, that is what a lot of people are holding their hats on. And ultimately, it's going to come back to the price action and come back to how fearful the market is and whether there's too many puts. Remember, when everyone gets terrified, you have to start thinking a little greedily within risk management parameters. Retail net imbalances last week hit record highs. In just one day, in 1 hour, retail traders sold off $1.2 billion of stock, single stock this is, and totally got terrified. So people are absolutely freaking out, there's no doubt. But we did see on the other flip side of that, remember, do what they're doing, not what they're saying. We saw a whole bunch of massive transactions. FNGB, which is a 3 times leveraged FANG stock fund, got monster transactions. The number 1, the number 2, and the number 3 largest transactions in the last 2 years all came through near the lows. And while since then we took another low, remember, this doesn't necessarily mean that they are absolutely terrified of taking a little bit of a lower low. They're not going to absolutely smash the bottom, because big Wall Street funds, they don't really have stop losses. Remember, they position-based trade or invest. They actually just build a position over time and then use their algorithms to obviously trap retail traders into certain ways. Here's another example of the clusters we've been looking at. And of course, I'll be looking for more of these for us this week. So make sure to subscribe and smash that alert button, as this may be one of the most important reads this week, which is going to be continuous dark pool transactions and price action that goes above these levels. And that will be the key. Price action must go above these levels. On another flip side, we talked about synergy in markets. Well, we've even seen Tesla get absolutely derailed into $250. Now, we know that 250 is a huge put level. We'll look at it soon, but we also know this has been where previous large transactions come in. And just remember, clusters matter. So if we start to see clusters appearing on Tesla, price starts to improve, that could be a really good sign that Tesla's finding a base, and that indeed Nvidia and other stocks may also be finding a base. So it's really this critical zone. And why is it so critical? Well, we may need to do a little bit of upkeep here on our thoughts on Wyckoff. So if you're interested this week, let us know, and I'll do a bit of a special section in the Daily Show where I'll talk about Wyckoff and what I'm actually thinking here, because Wyckoff is an incredibly important thing. I put it in our courses over at fxevolution.com and obviously talk about the bits that I think matter and the bits that don't. But generally speaking, if we drop levels such as 5,700 on the S&P, then we are putting ourselves under incredible strain to be able to hold this market up. Remember, we've had a dull market in recent times, making slightly higher highs. It's one of these classic distribution style patterns. So if the market can't hold these levels, then that could lead through to further selling, and of course it can feed upon itself. Now, there have been some big announcements. Obviously, the White House here account saying America will be Bitcoin's superpower of the world, and the golden age of America has begun. Now, this didn't actually move Bitcoin at all, but of course, it was the announcement only a few hours ago. And we do know that overall Bitcoin is most likely pretty heavily oversold. Like, it's obviously being thrashed recently, but we've also had these huge volatile switches. At the moment, we're looking at the golden pocket, that is the 61.8 to 66 GAN level, and that's where we're basically focusing on whether the market can hold up from there. We also know that flows have been kind of going up, down, and all around. Now we're looking at the last 7 days of flows to the Bitcoin funds as negative 283 million on Bitcoin here. And you can see on Ethereum, we've got about 157. All right, let's now jump on over to what was happening in rotation world. We saw utilities pick up throughout the Friday session. Semiconductors came back after getting smashed in the morning session, as you can see here. And everything kind of changed as guess who? Jerome Powell started to say a couple of things. Now, what were the big takeaways there? Probably changing the dot plot, I thought was pretty key, basically suggesting that the Federal Reserve may be accommodative in further rate cuts. And also, who knows, maybe a bit of QE on the horizon, guys. What do you think about that? We also know here that we saw effectively a day of generally risk buying back on after selling in the morning, with the jobs reports a little bit weaker than expected. I think people are just really using that as an excuse, though, because we didn't see it shocking. It wasn't shocking, Let's have a look here at gold. Gold is now the best 5-day return. XLV, one of our favorite sectors at the moment. Healthcare actually eking out a small profit, considering everything's going on. And yeah, no surprises really that agricultural stocks are doing well. They also did well in 2017. I've been highlighting that a little bit in our private groups, links in the description down below. Now let's jump on over to the S&P 500 and have a look at the options and the key technical levels. And guys, this is such a zone. We took it early. So we went underneath 5,700. You can see here the real market pressured that level, and luckily it found buyers. Now that's important. And of course, it's exactly what you want to see. And we can now start to price out these 58.70 kind of areas. And we'll look at the futures market in a second here. But you'll notice this is oversold. 6 consecutive down days on the Russell. This is the S&P. We've gone down now for a little while. And of course, we've got this 58.60. So let's have a look at the futures market action. Here are the options highs and lows. They're back, guys. There you go. And we've also got that magical alert up here at 58.80, 58.75 to see whether the market actually wants to put positive structure in. Now, this is very important because at the moment, what's occurring, it's a series of lower highs and lower lows. Now, whenever you see that type of thing, you've got to say, well, the market is actually quite bearish until proven otherwise. We did get the tweezer last week, which is here. We were unable to break higher above the tweezer. Now, the tweezer's on the daily if you want to check it. But we did also get a nice wick rejection off the lows here. And it actually made it, I would say to the supply, which is probably around 57.80. So 57.80, also an important level for bulls to reclaim. I'd say this is the big one. But remember, there are smatterings of big dark pools all the way through here. Dark pool, dark pool, dark pool, dark pool. So basically we have 4 major dark pool zones that Wall Street has been at least activating some type of trade on. I have an assumption it's a buy, but that being said, we do need to really see price action confirm that. Just remember there's something going on here, and you can really see those end of days as well. Volumes are ticking up, and that usually tells you that there's big transactions coming in from the street as they do most of their trading near the end of the day. The most important thing, it held 5,700, 5,700, 5,700. Let's have a look why I'm saying that so many times. Yeah, I think you can see it straight away. Everyone here, you don't have to be an options guru genius, guys, to see the fact that there are a lot of 5,700 puts. Take a look. 5725, 5,700 here on the 21st, which is the OPEX level. And then, of course, we also have a whole bunch of puts everywhere for April. Look at this, 5,800s, 5,600s. There are just puts. Just a month ago, we had calls everywhere. Now we've got puts everywhere. So these are very important levels to hold. And basically this week is all going to be about 5,700. And therefore, when we go to seeing the inflation figures later on this week, that is going to be the key. So if the inflation figures come in, it doesn't necessarily mean if they're bad or good what's going to happen, because it could be bad equals, I don't know, QE or something. Who knows what they're going to do? Or it could be good equals, okay, well, then we can bounce off the lows. The thing about this market is that it's really price action derived. So do we have too many puts in the system? Yes, they're extreme levels. Do we know 5,700 is the extreme level? Yes. If we drop it, what's going to happen? Well, if we drop it, we could move 56 or even 54 very quickly. And remember, negative 3.5% from the close on the NASDAQ. If that does happen over the next 2 weeks, that's not a good read. It's not guaranteed, but it's not a good read. Let's now have a look at Nvidia. What's going on here? A bunch of puts floating everywhere. It's very spotty here. We'll get more data as we go through the week, so we'll obviously update this. But we did close underneath that important 115 last week. So that's kind of not that strong here for the semis. We'll have to watch it very, very closely. When you're looking at something like Tesla, 250 is the major level. Again, everyone can see it. There it is. 250, 250, 250. It is again important over the next 2 weeks, because remember, these are weekly options, 14th and 21st expiration, that we hold this level. So if you're a Tesla bull and you're saying, man, this sucks, Tesla's down like almost 50%, I guess, from the highs when it almost hit $500, then is it going to find support? Between 220 and 250 is where we've speculated for a while that it will find buyers, and it did. Straight on 250, bam, there's a buyer. Probably no coincidence, something's there. Let's now have a look at the bonds indicators, the lead indicators for these markets. Are bonds freaking out? Yes and no, volume is up. Obviously, bonds are down. This is one of my 7 key reads when I'm looking at markets to tell whether this thing is absolutely cooked or not. I wouldn't say bonds have absolutely freaked me out yet. They've certainly started to show a little bit more fear in recent trading sessions, the last 2 weeks in particular, but they're not what I would call diabolical towards a full-on recession at this point. And usually this will lead the markets overall. So I would say it's okay for now, although needs to be watched. On the other one, which is of course bonds and option spreads, you'll notice here we made that doubling bottom, which basically is led through to more fear. If we do see price action coming back up and this starts dropping, great sign that the price action has found the low. If we see price action bouncing back up and this thing starts to accelerate up, yeah, you guessed it, dead cat bounce, guys. That would be bad. And of course, we'll alert on that one as well. I can tell you liquidity has slightly inched up over the last couple of weeks, which is, a key read as well. Home builders finding its support base, again, critical level, big volumes. Look at all the volumes coming through here. Everybody's having a go at these things at the moment. And the US dollar continues its huge drop. which you could say is engineered. Now, a lot of people believe that if tariffs are implemented, usually the dollar will go up. But you got to remember, it's like a buy the rumor and then kind of a sell the fact. Now, this is exactly what happened in 2017. So with them going on and going off and all sorts of things happening, and plus, all sorts of other geopolitical stuff going on, just remember that we've been calling this dollar low. We've been saying it's most likely shorting. This actually is fairly normal for the stage of the cycle that we're in right now. So I wouldn't be surprised at all for relief rallies in the dollar to be met with sell demand. And if you're on the euro over the last week, congrats to you. The euro was a very strong trade. Let's now have a look at gold. Up, down, up, down, up, down. Stuck in a range. No problems, guys. No problems. This is good. We love gold here on the channel. We've been bullish, as you guys like to say, since the 1800s in terms of price. But in general, remember, this was a calculated play over the last 2 years, and it was based on geopolitical tension rising. It was based on BRICS versus SWIFT. If you're not familiar with that, you need to check it out. It's based on just where we are in the cycle and how badly gold has performed up until that point. So there are a lot of still bullish catalysts for gold. Of course, we called 3,000. I guess you could say, well, didn't quite get there. I did warn people 2950 was my projected target based on technicals. And if it sits here and it keeps going range, that's not a problem. I don't mind with it going range. It can range for 2-3 months here. That's fine with me. In fact, it's actually pretty normal for it to range into the back of March and then hopefully break out. And if it does, I'd say it smashes 3,000 on the upside and goes, let's say, 3,600. That could be a good level as well. Again, in trajectory basis, that would be at least what I would expect in a normalized bull run for gold. Let's have a look at silver. Now, silver's been a bit of an abomination, you would have to say, for a little while, but it's picked up this year. And as we've shown, silver-gold ratio is improved. Have a look here at the overall levels, though. Take a look at these 2-week rejections. Strong movement up. Good stuff here. I like it. I'd love to see a new high here for silver. We've been bullish on it. This thing is sloth, but hopefully it will pick up some more. So we're looking for a break. 3280. I'm not even sure this first resistance is going to matter anymore if we get above this. These are good weak rejections, showing a bit of strength there for silver. So that's nice stuff. Now, oil, on the other hand, absolutely diabolical into these supports. This is the level for oil. If we drop this level, then yeah, you guessed it, possibly a huge sell-off across the board. And in some ways, it's kind of following what the yields are doing as well. If the yields drop off, then yeah, if oil drops this level, then usually 10-year, 20-year, 30-year yields will also be dropping. And that, of course, could also help treasuries. So that'll be an interesting trade this week. As you can see here, treasuries have just gone to fill the gap. So a lot at stake. Oil certainly worth watching. I'm not sure if it's a great trade or not. Geopolitical stuff is tough this year, so I would probably stay away from it. But it's a great level to be watching. Now, let's have a look at Tesla and these single stocks before we go to the other indices in crypto. What's going on with Tesla? 250 achieved. I'll have a look here. Let's say the price 251, let's say. This is a pretty good level. It's obviously a gap fill, which is the key. So that's the gap close, completed and done. So we'll mark that out there. And by the way, you should always mark your gaps. So just go in there and just say gap level, and then you can at least see it on the charts because these are key zones. Now you might say, what about this one? Well, you definitely should mark that out as well. I tend to mark close to close. Some people mark week to week. Doesn't really matter too much. And there are both merits in those reasons. But have we seen enough to say, wow, I think Tesla's, totally turned around? No, this is a key level for that buy the dipper that says this thing is extremely oversold. For me, I usually like to see a bit of price action, pick it back up. I always say if you see a reaction to it, then you're not really making a prediction. You've got patience. Temperament is the number one word in the investment trading game. So that's a very key zone and definitely worth watching. What about Nvidia? Well, not great. Still a series of lower lows and lower highs. We need a higher high. Let's get a 120 plus. 120 plus, that will actually push out, a lot of bears, could create a squeeze. Again, a stock you need to be watching is definitely going to be Nvidia. And if you look at semiconductors, you'll notice here again, we're going to need a 231-ish close. Now that's to switch what has been a series of lower lows and lower highs. It's not rocket science. We need a higher high. Let's get a higher high. Higher high will get markets back in. If you're a bear, you do not want a higher high. No higher high, you say. Go down. Close below 57 on the S&P. Get smashed. That's the type of thing a bear would want. A bull wants those levels to be taken though. And meanwhile, in defensive boring land, which is, of course, our healthcare sector at the moment, been very bullish on this year, it's boring. It's not to be unexpected. This is healthcare. It is like this. It's a snail, guys. So you've got to remember, it's not exciting, it's boring, but guess what? At least it's held up. Let's move over now to some of the international markets. First up, Germany. You can see here look at the volume going through it at the moment. Everyone is obviously trading the defensive stocks as Germany and a lot of Europe actually start to arm up. And that's really pushing, I guess, their GDPs, because a lot of people know that if you track the spend on something like defense, it often does juice an economy. So everyone's been chasing that. I would say now is not the time to chase those particular stocks. If you look at Reinhardt, I think, which is the German stock, that thing is or Rheinmetall, it is absolutely insane in terms of the amounts of weeks. I think it's got 3 or 4 weeks of significant super 2, 3, 4, 5 standard deviation outliers. That is not the type of thing I'd be buying into. If you're in it, ride it till it don't ride no more. But yeah, you got to be real careful on those levels. Let's have a look here at HSI, one of our favorites of the last 2 years, as we call the bottom over here. Seems pretty good now, doesn't it? But, realistically, it wasn't too bad over here either. So this was a nice move. We actually almost hit 25,000, which I thought is a pretty solid level for the Chinese market. But you've got to remember, where did you come from? So you came from like 30,000. It's been absolutely smashed, gone through effectively a pseudo recession. And in this case, it's still bullish. So it's that daily 20 that you want to be watching, guys. We already mentioned this last week. And you can see here the previous resistance level, daily 20, big bounce off it. Still bullish for now. And actually the entire world market, not the US market, but the world market is actually firing pretty heavily, with financial sectors across Europe also doing okay. So there you go. You've got a kind of global market doing all right, but the US market is probably the laggard of this year, and it's been only some sectors that are doing better. Let's talk about a sector that has done poorly. 6 weeks down. Are we finally oversold on US 2K? You'd have to think so, yeah. Statistically, yes. However, we still haven't even got past 2120. So look for 2120 this week, guys. You can see here there was a bit of action near the close. This is, of course, important. If you have a look at the daily, it's going to be a wick. That's good, but it's basically a doji. What does a doji mean? Yeah, it's pretty significantly kind of high-low, open-close near the same level. Volume's up. Oversold, yes, it is oversold. It's oversold. Technically, it should bounce. However, it hasn't seen any price action yet. So looking for the big trades this week, we'll be paying attention. What about the NASDAQ? Again, synergy across the board. Look at this giant trend line. That's a good trend line. That's not really even speculative, that trend line. It's pretty much a trend line. So that's a key level. We oversold, we bounced back up. As you can see here on the NASDAQ, it's the same kind of thing. A series of lower lows and lower highs all the way down. So we haven't seen a switch. What are we looking for? 20,000, probably about 700. We get above that, we're looking pretty good. Now, some people will obviously already be trying to buy here and then buying the dip here and putting stops below the low. That could have been the low of the market. But we don't know that because, of course, we don't have price action. We haven't broken stuff. I like this chart, though. I think we'll be looking at this one quite a lot over the next couple of weeks if we're able to do some repairing, because there's a lot to like about the technical overlays on this one. What about Ethereum? What about crypto? Not moving much. We're sitting about 2,200 on ETH, up, down, all around. Absolutely slow in the crypto world, even with these big announcements, supposedly. So the problem is that people have lost faith. And when you lose faith, it doesn't take long to bring it back because, people are greedy, FOMO and fear. But when people lose faith, it's hard to get it initially back. You've just got to, kind of get that really good juicy moment that everybody starts to buy back in. Now, for Bitcoin, I think the key here is going to be this 84,000 level, this 61.8 fib. We've seen it bounce. It's obviously been down, up, all over the place. A lot of people are going to be trying to short this thing at the moment. Yeah, fair enough. I mean, it is fair enough. If you short it up here, congrats to you. It's not too bad. And of course, it's another one of those Wyckoff style distributions. So if it's going to go really bad, I wouldn't be surprised at 68K, before you really see buying pressure. But for now, this is the hold level. Around this 84, we need a higher high. So if you want to wait, you have to wait until you actually see some structural repair. And all we know is that there are weak purchases around 84 to 85,000. That's all we know at this stage. For the week ahead, there are a couple of things to note. First up, daylight timing shifts for Canada and US. And of course, as we scroll down here, we've got the core CPI models coming in. So we'll see how that inflation number looks. And we'll get some pre-rec kind of like calls on that to see what the general industry thinks. And of course, core PPI coming out Thursday. I love that month that we had it before. Yeah, remember that? We could actually make a big move. And then prelim UOM consumer sentiment. So there's a little bit of news. It's really just about inflation on Wednesday. And just remember that will come out 1 hour before the market opens, 8:30 a.m. If you prefer to look for a catalyst, this is the type of catalyst that will either push the market down or rally it up. And we probably will see structural change around this event. That's where I'm expecting it anyway. If you enjoyed today's video, please remember, guys, to subscribe if you want to find out more about how to find the right sectors, how we kind of picked gold, how we picked things such as China, and obviously we've been doing healthcare this year. Then check out a 7-day flash sale. I'd have to recommend the advanced masterclass for that sector analysis and just everything to do with the debt cycles and things that we're in all the time. And you will be blown away by that one. Follow us over on X as well. And of course, check me out on LinkedIn. I've got a couple of good posts there this year for risk management. And this year is 2025. And guys, this unfortunately is the word of the year. Risk management is very important. No emotion. Have a great weekend, guys. Hopefully you've survived what's going on right now. And remember, patience, react, don't predict. Thanks so much. You have a great weekend.